Today we have the pleasure of having Aaron Grinhaus on with us. We've had him here before. He is a great attorney up there in Canada, and he works with a lot of our clients on the estate planning side when they're dealing with digital assets up there. How are you, Aaron?
I'm good. Yeah. Thanks for having me back.
Absolutely, brother. We've had a lot of questions. We've had a lot of people set up LLCs here in the US that were Canadians, and that's not the best way to do it. So, anyway, we're just looking through things and we thought it'd be a really good idea to have you back on and kind of run through some of the best practices for Canadians when they are establishing their estate and what that looks like if they do want some presence here in the US.
Yeah. I wanted to also say that I appreciate you having circulated. My name comes up a lot among your clients, and a lot of them reach out to me and they've expressed to me how difficult it is to find legitimate information about crypto tax.
Yes.
It's hard because there are very few people, and particularly in Canada. So there might be some good resources in the US. And when some people look, I mean, I have people resorting to social media. They're looking on X and other places to try and find tax advice, which is really inaccurate, to the point where a lot of the people that have come from you or just from all over the place, we get referrals from. They've asked me to start doing a podcast about crypto tax in Canada.
Awesome.
And in speaking with your colleague yesterday and a few other people, we are in production of doing that. So if anyone watching this is interested in being included in when that comes out, just send an email to info at grinhauslaw.ca, grinhausLAW.ca, and just put in the subject heading podcast, and I'll make sure that you're informed when it becomes available. And that way people are getting legitimate information from somebody who actually acts in this space. So I know you've mentioned this in the past, but just as a quick background, I'm a lawyer. I'm based in Toronto. I have a law firm. My background and expertise is in tax structuring, corporate and estate planning, and with a niche expertise in crypto. I started out in the space around 2015. I was originally, just dabbling, investing in Bitcoin and ETH when it first came out. And then I was got really interested in the technology, became one of the few lawyers in the country, like really a handful,
Yeah.
who were doing this stuff. And I was doing crypto tax structuring, Bitcoin mining operations, BTM operations, ICOs, everything you can name. In 2018, I published the first textbook in the world on crypto tax, on digital asset tax. I've been the co-director of the Osgood Law School blockchain program for the last 7 years. And I teach at Osgood. I'm an adjunct professor at Osgood on international tax and Web3 tax law. So on the practical side, on the personal side, and on the academic side, I've done it all. And I'm always happy to speak to people. If you have any questions, please feel free to reach out to me directly, and my email address is available, I think, in the materials here. So I just want to start off by saying that although I'm giving some information here, disclaimer: tax is very fact specific, and I'm not just saying that because I'm a lawyer and it's a cop out. Like, it really is. If you're single or if you're married, that can make a difference. If you're a Canadian citizen but a U.S. resident, that makes a difference. If you've got a home that you own, that will make a difference. If you own other investments, it will make a difference, because what we decide to do might be an international structure, it might be a cross-border structure, and it might just be a domestic thing. And what you do will determine what the tax consequences of all those actions are. So I just want to have that little disclaimer there first. The second thing I'm going to tell you is that last week or two, the markets have been going wild. But from a regulatory perspective, particularly, I know a lot of people on your in your group are into Ripple, right? Into XRP.
Yes, sir.
And there might, even though everything's been dropping like a stone, we're looking at the possibility of a Ripple ETF
Mhm.
being approved. We're looking at uh potentially the SEC, the Securities and
Wall Street.
yeah, like those might be, they've been dropping a lot of those lately against Coinbase, against other crypto companies. And the biggest one that's on everyone's radar is, what are they going to do with Ripple? What are they going to do with XRP? So if these stars align, everything could pop right back up, and you want to be prepared for that. And having the structure in place now is what helps with that. Also, I just read in Texas, I'm sure this is on your radar, Jake, but coming to the Senate floor is a strategic Bitcoin reserve in Texas.
Mhm.
So many states are considering or doing this. So the movement is still happening. Now, if we're talking about Canada, like most countries, remember tax is very political. Tax is one of those things that's like a mark of sovereignty that people do not want to mess with. And in Canada, like in many other countries, it changes every year when the budget comes out. And we will likely have not only a budget, but an election this spring federally. So I don't know if you know what's going on in Canada right now, but there's a bit of a it's a bit of a mess, right? We have no real prime minister is effectively resigned, and it's been this way for a few months, and we're trying to figure out what we're going to do. But the point of all this is when we do have an election, if one party like the Conservatives come in, they've already shown how they are very crypto friendly, very regulation friendly, and they're going to scrap the capital gains rise. So that we were going to raise the right, and that there was not a lot of political will for that here. In fact, the ruling party postponed it for another year. Even though they said it was in effect, they haven't actually passed the law yet. And so they pushed it to 2026. And now, if there's an election and the Conservatives win, they said, we're just going to scrap it altogether. So we've got a lot of positive potential outlook. So that brings us to the questions and the content. So the first question that that was brought to me before we started this was considerations for Canadians when incorporating in the US. So let's talk about that for a second. So a lot of people listen to your podcast and they listen to your information, and a really beneficial strategy in the United States is to have what's called an LLC. Now, an LLC is an interesting type of entity. So it's what's considered an S corp in the US, right? So we have a C corp and an S corp and a partnership. Those are kind of the three general business structures. And I want to just briefly explain the difference between each one, because that'll lead us to how we should do it in Canada if you're Canadian. So in Canada, a C corp is, and in the US, it's like it's like a person. It's
Mhm.
like another person. It files a tax return on its own and it insulates you from liability. So if you're a shareholder of a C corp, you don't, and the C corp gets sued, you're safe, you're protected. If you're in a partnership, however, which is the other end of the spectrum, let's say Jake and I form a partnership, it's different from us being shareholders in a corporation. We're the ones who pay the tax, and we're the ones who are liable if the partnership entity or the partnership business gets sued. An LLC, which is unique to the United States, we don't have this in Canada, is kind of in between the two.
Mhm.
So, on the one hand, you do get the liability protection if you're sued, but the shareholders or the partners are the ones who pay the tax.
Yeah.
So, and it's considered an S corp in the United States. So, a C corp pays its own tax, assumes all the liability. The shareholders pay their own tax if they take a dividend or a draw from the corporation, but the corporation itself has to file its own tax return. And if the corporation gets sued, the shareholders are not liable. Partnership, the partners have to pay the tax and they're the ones who are liable. And by the way, it could be a partnership between corporations. That's okay.
Mhm.
But it's different from a C corp. An S corp is in the middle where the shareholder partners pay the tax, not the entity, but they are insulated from liability.
Yeah. You get the
So
best of
here's
both
where
worlds.
the problem. Yeah, sorry.
You get the best of both worlds.
You get the best of both worlds unless you're Canadian. So the problem is in Canada, we don't Canada doesn't recognize LLCs. So the consequence of a Canadian having an LLC is they get taxed twice. Once the entity gets taxed in Canada, and second, the individual shareholders get taxed. So what it results in is double taxation, which is why it is not a good idea for Canadians to set up LLCs unless you have a more broad plan or a more broad picture. So generally speaking, if you're looking to use a corporation for crypto investment or yield farming or any other types of activities, not a great idea to use an LLC. Instead, we will stick with a C corp, And I know that you have services that require Canadians to be incorporated. So what we'll do is, this brings me to the second best practices, which is called a rollover. So how do we get let's say we've decided now you need a corporation to do what you want to do in the United States, to invest or yield farm or whatever it is, and you're required to do it because of, Digital Wealth Partners requires your corporation, or something else in a custody requires you to have a corporation or whatever. So the next step is, okay, you're an individual with digital assets and you need to get them into the corporation now. Now, the problem in Canada is if those digital assets are, and in many cases, they are treated like capital property, then putting them into a corporation that you own and control triggers a tax consequence. It's as if you sold them to the corporation at fair market value. And even if you don't take a dollar out of that corporation, it's as if you sold it. And let's say you had, $100,000 worth of Bitcoin and you put it into the corporation,
The tax consequence.
you're deemed to have received $100,000 and you have to pay tax on the gain, on whatever gain there is. So there are two ways that we deal with this. There are two different ways that we could deal with this. Number one, if you have an existing corporation with cash in it already, then this is a good way to strip that money out, because what you're doing is you're taking the money out as a capital gain. If you just take it as a dividend or you take it as a draw, it's taxed at a very high rate. Okay, dividends are taxed at a lower rate, but still at a higher rate than capital gains. So if you sell your digital assets to the corporation, you can take those retained earnings out as a capital gain. It's a good way to strip income out. But sometimes, sorry, do you have a question?
Could you sell those assets at a loss, like less than fair market value to the corporation?
No, it has to be fair market value because it's non-arm's length parties, right? So arm's length is me to you. If I want to sell you something, if I want to sell you my house for $1, well, there's still a question of how that's treated. But if it's fair market value, then it is what it is. We bargained, and we have equal bargaining power, and we just. But if it's from you to a corporation you own and control, it's deemed to occur at fair market value. So you can't choose what price you want it to be, generally speaking. Okay, so if you decide to sell your assets, it's still good. And it's called a capital gain strip, which we used to do in a different way where we would manufacture certain corporations and things, but they closed that off by amending the Income Tax Act last year in June. Yep. So we're coming up with more creative strategies. But for now, one of the best things is if you have any capital property, sell it to your corporation if they're retained earnings and we can get it out. But in most cases, I would say for people who are dealing with you, they don't have a corporation, or if they do, it doesn't have a lot of retained earnings. And in any case, if you have an operating business that has a lot of money, you don't necessarily want to commingle your
Well, there might be a little busy there that,
Yeah.
got sued, then those assets are now exposed to that lawsuit. Right.
Yes. That's one thing. But another thing is, if you have an active business with income, you don't want to taint the capital treatment of your crypto with income treatment from your business, because then if you sell your crypto and you try to declare it as a capital gain, and the tax authority comes and looks at it and says, you know what, this is actually active business income, we're not going to let you take the capital gains treatment, so you lose, right? So it's good to segregate that, right? Keep it separate. And so the next thing that we can do is called a rollover. There's an exception in the Income Tax Act that allows you to put those capital assets or other assets into the business. And instead of taking cash out, you can take it back shares of equal value. Now, this is a complicated tax procedure. It has to be done the right way, and the corporation has to be structured a certain way because you have to have certain classes of shares to allow it. You have to subsequently file an election form with your income tax return. Like, there's a lot of rules you have to follow to get it done. But we do a very high volume of this, and we can turn them around within about a week. And we can help your accountant if they're not sure how to do this. We can help them go through it. So this is the strategy that most people go with to avoid that tax consequence. So those are two really important points for Canadians to consider when they're looking at setting up corporate structures for crypto holding or crypto trading. Okay, so that's number one. I don't know if you have any questions about that so far before we move on to the next part here.
That's kind of what we do here in the US. So when we move the assets into an LLC, we use them as a capital contribution in exchange for the equity units in the LLC, right? So It's a swap of that value. You're moving your assets in there to capitalize the business, and for that contribution, you are getting the equity that you now own the corporation. And
Yes.
so it sounds like the same thing there in Canada, except it's with a C corp entity versus an LLC. So it would be the stocks, and you would have to have special provisions for the certain types of stocks that are able to be swapped in that manner to be able to do the same do-si-do that we do here in the U.S.
Yeah, I mean, another option is doing it as a loan, but with capital assets, that's not so good. If you want to
Yeah.
capitalize the company with loans, like of cash, that's different. And in this case, though, that's not really what we're talking about. We're talking about rolling digital assets into a corporation for the purpose of either yield farming, investing, or doing other things. Now, there's two other side notes I want to mention. One, I get a lot of questions about trusts. Now, trusts you can think of as flow through entities, okay? And they're used in many different ways to distribute revenues or funds of some other kinds to other individuals through the corporation. If this is something that we can discuss, because it is really a case by case basis situation. Same with offshore. So people ask me a lot about offshore, and we do a very high volume of cross border offshore advisory, offshore company formation. We have an associate office in the Caribbean. We do a lot of work there. So, we can advise you on that, but I can tell you that unless your assets are a million plus, or you have other significant reasons to set something up there, in many cases, you're going to have to terminate your residency in Canada to make it worthwhile. So it's very fact specific, can be very expensive to set up. But if it's worth it, it's worth it. That's what I really love about tax. And I know you don't hear people say that phrase very often. That's what I love about tax. One of the things I do love about tax is that it's objective. So you can decide, like, do I spend all this money to set up this structure? Well, you only do it if you're going to save this much in tax. So it's objective, right? Yeah, you can not do it, but then you're paying X dollars in tax. But if you do it and it costs you a bunch of money to set it up, but then you save 10 times that amount in tax that you would have otherwise given to the government, it's worth it. So we do that analysis. We'll decide whether it's worthwhile for you. And then if we need to pull a trigger, we do. We just get it done. And then, so that's the offshore and trusts discussion. The other question that Jake, you wanted me to discuss here was best practices for Canadians to use when managing digital assets. So I have a few comments about that. So one thing is to remember that tax systems are generally residency based unless you're American. So in the US, it's citizenship based, which means if you're a US citizen who's living in Canada, you are you have a bit of a confusing, and anybody who's listening here who does have either dual citizenship or US citizenship who's Canadian resident, you'll know that it gets very confusing at tax time because certain things, there's no double taxation. There's a treaty that says that anything that's taxed in one of the jurisdictions, you don't have to pay tax on in the other. But if there's something that you did have a gain on that wasn't taxed in the other jurisdiction, you have to pay tax on it in the other one, if that makes any sense. So a good example, an easy example, is your principal residence. In the US, you can write off your mortgage amounts, right? You can't do that in Canada. In Canada, the entire amount of your principal residence, when you sell it, the entire gain is tax-free. In the US, it's not. So if you sell your house and you exceed the allowable amount in the US, in Canada, it's tax-free. Even if you're a Canadian resident, but you're a US citizen, you have to pay tax on it in the US.
So,
So,
what if
sorry, go ahead.
what if Trump makes all American based cryptos tax free here in the US? If you have those and you sell those for capital gain, it's tax free here. But if you're in Canada, you're still going to
Oh,
owe
pay tax.
taxes there in Canada.
Yeah, pay tax in Canada.
Wow.
Yeah. Yeah. If you're a Canadian resident,
Right.
right? If you're a US citizen who's Canadian resident, or a US citizen who's also a Canadian citizen who's a Canadian resident, and then you terminate your Canadian residency and go back to the US, then you're not subject to the Canadian tax regime anymore. However, there is a consequence to terminating your tax residency. You can really only be a resident of one country at a time for tax purposes. You could be a citizen, you could be like have multiple citizenships like Elon Musk. right? I think he's got a U.S. citizen, he's South African, and he's got Canadian citizenship even, right? But he's a U.S. resident. So for tax reasons, he's just U.S., right? I think he lives in Texas,
Yeah.
actually. Yeah. So, but if you're a Canadian resident who's a U.S. citizen and a Canadian citizen, you decide to terminate your Canadian tax residency, we have to exit plan. We have to determine what is the tax consequence going to be for that termination. So think that's something to think about, especially if you're doing offshore structuring, or if you do want to, if you know there are some laws changed on the tax side in the US and people want to start repatriating themselves down there, we should have a discussion about that. And then
On the trust side of things, I just want to circle back to that for a second. They're in Canada, so one of the things that we look at here in the U.S. is the lifetime gift tax threshold. So we have a lifetime gift tax of anything over 13.99 million per person here in the U.S. So it's like close to 28 million, or yeah, close to 20 million if you're a married couple that you can gift out of your taxable estate. There in Canada, there is no limit, right? Like you can gift till your heart's content into
yeah,
a trust or
if it's cash, if it's cash.
so not digital assets. It has to be
No, no.
cash.
Yeah. So if you start gifting digital assets to people, there's a tax consequence to the giftor, the person giving the gift.
What if it's a currency?
If it's cash, it's okay.
Well, so how is it written? Is it written Canadian dollars or is it written as currency in the
Oh, that's a good question. I'd have to look into that. I'm not sure how that is. It's probably currency, I would say.
if it's
It's probably
currency,
cash.
I think there might be a loophole there for XRP in particular.
Well, not stable coins though. Stable coins don't count.
Right. Well, XRP is it's not a stable coin, obviously.
No, but they were coming out with one though.
Yeah. So Ripple,
There is a Ripple stable coin coming out.
yeah. Which,
So, but yeah, that's where it gets a little. But the gifts, using gifts can be good, especially with estates. But typically, if you are giving gifts that are taxable, the important thing to know is that the giftor, two things:
that
the
person
giftor
pays.
is the one that's responsible for the tax, and the person receiving it will receive it at the cost base at the time that it's worth.
Oh, really?
Okay, so
So
like
it's just
they
step up.
receive it, yeah, and yeah. So that's a pretty big advantage when you're receiving it, keeping in mind that somebody is still paying the tax, right? Like they're receiving it at cost base, but they're not somewhere the government's getting its money, right? The person giving it is the one paying the tax. So the gain has been paid for, in other words.
Right. Yeah. So there, it's going to be paid somewhere.
Yes.
I, I'm interested in that potential loophole because FinCEN designated XRP a currency in 2014 here in the U.S.
Ooh.
So if it and Congress in the Stablecoin Act or the bill that they have on the floor right now, it would be designated a bridge currency. So I don't know if it'll fall under that qualification or not.
Well,
Nice
nice to see when the guidance comes out. Yeah, there's a lot in the hopper right now. There's been a lot of activity in legislatures across the board because of the election. Europe's pretty well settled. They came up with their framework, which is pretty good. Canada's got its ideas, but again, we're gonna have an election soon, and everything could change. Yeah, so we don't know where it's gonna go. And just so you know, the crypto community has been very vocal in Canadian politics, and they've been hosting the leaders and like they have a lot of influence. They have a lot of influence. So we'll see what happens. Uh, so yeah, so when you have dual citizenship, that's something you should consider because or if you have U.S. citizenship and you're a Canadian resident, we have to consider the best ways of doing things. And then the other thing to always think about is capital gains versus income. So whether you are holding crypto and you want to cash it out as a capital gain depends on how you've been trading and using it. If you just bought and held for a long period of time, chances are it's capital property. But if you've been doing trades over time between cryptos or just buying and selling, and if you're just accumulating, that's okay. But if you're selling and buying and selling and buying, then that could taint it. And also, as I mentioned earlier, if you start commingling assets that are income in a corporation with capital assets, that also could taint it in the eyes of the CRA, or the Canadian Tax Authority, Canada Revenue Agency. And so you want to try and separate that if you can. So if you have, so what I often will recommend people to do is, even if you are rolling assets into a corporation, keep some of it in your name personally as capital property and just hold. So if you've got, 100,000, put 25% of it in your name, like keep it and roll 75% into the corp. That way you actually have the option of retaining the earnings in the corporation. Don't have to pull it out. Even if you reach a time where you think it's reached a high and you want to like cash out, keep it in there and then take a capital dividend later or do something. But in the meantime, you can cash out what you own in your name personally, slowly over time. The other thing is, if you have any possible way of incorporating your employment. So if you are an independent contractor, you can become an independent contractor with your employer, as long as we can substantiate it, and we can go through that analysis and discuss it in more detail. But that's great because then you can keep your income from work in the corporation and pay 13% on it, and as opposed to adding it to your personal income, and then cash out your crypto slowly over time to live off of as capital gains, and you're paying very little tax when you do that. And so there are ways I can go through with you based on your situation to maximize that calculation. And then I think that was pretty much most I was going to cover. I was just going to say, I put my email here and uh, my name on the Zoom window here. So please, you can reach out to me directly if you want to discuss your specific situation further. Check out the website, which I think we're going to list the URL in the materials, Grinhaus Law, GRINHAUSLAW.ca, which has a number of resources, a number of articles, and talks about what we've been up to and what our services are and the resources. And of course, please, if you want to find out about the podcast, info@grinhouslaw.ca with just the subject heading podcast, and I'll make sure that you're informed when it becomes available and how to get access to it.
That's awesome. Super glad to hear that you're doing that, because I know that there's a lot of confusion up there for Canadians on what best practices are and how to be able to mitigate taxes on their estate for their digital assets. Because again, like we mentioned earlier, there's just not really that much information out there. There's not enough people that are actively working in this space that are, putting the information out there available for people. We've seen a lot of success here in the U.S. Based on our presence and just putting out media around these topics. And super excited for you to start doing that too. And we'll continue to refer you people. Again, I think you're the best tax attorney up there in Canada for this stuff, and that's the reason we've chosen to partner. So thank you again for being on the show. We will have all the links that he mentioned down in the show notes below for this on YouTube and all the other platforms where we listed. And yeah, appreciate you coming back and taking the time here.
Yeah, thank you again for having me. I really appreciate our relationship. I love the people that we work together with, and the services you offer are great as well. And I'm always trying to recommend them for people as well.
Appreciate you, brother. We'll see you on the next one.
All right. Thanks again.